Hello, Matthew Bell here, and today I want to talk about the required minimum distribution. Now, as a preface, this topic is going to be fraught with difficulty and complexity. I can only hope to sort of scratch the surface, and I should say from the get-go that I am not a tax advisor, I am not an accountant, a CPA, I am not competent to give you tax advice. And for your specific situation, we're going to encounter a number of variables and factors that would be well worth speaking to a competent professional about and making sure that that person has full awareness of your particular situation. So having said that, I'm going to give you kind of a bird's eye view of the required minimum distribution. We're going to talk about it and hopefully gain a little bit of an understanding of what it is. But again, for specific tax advice, you're going to have to consult professionals in your area. First of all, the question is, what is a required minimum distribution? Let's start with that. So an RMD, or required minimum distribution, essentially is an amount that the Internal Revenue Service, IRS, forces you to take out of your retirement accounts, when those retirement accounts especially are tax qualified. And in another place I've talked about what tax qualified means. You can think of it essentially as a special agreement or relationship that the IRS has with you with respect to that account. So all it means is there's a special arrangement. And for IRAs and employer-sponsored plans like a 401k, essentially that arrangement is something like this. The IRS has stated that, hey, when you're putting money into the account, we're not going to tax you on that. We'll give you a tax break deduction. Then the money, once it's in the account, will grow tax deferred. We won't tax you on a yearly basis for that. But once you go to take it out, you go to take distributions or remove money from that account in retirement, we're going to tax you. And so essentially what a required minimum distribution is when the IRS gets sick of waiting, if you want to say it, you haven't taken money out of your retirement account, they're going to tap you on the shoulder and basically say, remember, we let you set that account up for retirement. You're in retirement. It's time to take some money out. So at the age of 59 and a half, you may start removing money from a retirement account. But at 70 and a half, you must. And that is what the required minimum distribution is. What accounts does it apply to? So in the first place, the required minimum distribution is going to apply to traditional IRAs and other IRA-derived vehicles like SEP IRAs or simple IRAs and so on. It is also going to apply to employer-sponsored plans like the 401k. It's going to apply to tax-sheltered annuities, 403b. It's going to apply to certain government plans like the 457. So those types of plans basically are characterized by what we described a second ago, and that is a tax deduction for a contribution and tax deferral for earnings. That is to say, the money in those accounts has never been taxed. Now there is a noteworthy exception, and that would be the Roth IRA. The Roth IRA is got a different agreement around it, and in that case you would actually pay tax on the money you put in, and then provided you satisfy the requirements of the distribution, then the money you take out is going to be tax-free. So essentially with the Roth IRA, you don't get a tax break when you put money in, and then as long as you are over 59 and a half and the account has been open for 5 years, you've had a Roth IRA for 5 years, then you do not get charged tax on any earnings and you take distributions tax-free. Now, there is one caveat, and that is that if you have a Roth within your employer-sponsored plan, so if you have a Roth within your 401k, sometimes it's called a Roth 401k or a Roth-K, then there are required minimum distributions on that. Not because it's necessarily the case that you're going to owe tax on it, but just because it's an intermingled or commingled vehicle, and that is just the IRS rule. But I'm really not going to talk about that. So for the most part, let's just understand that the required minimum distribution is going to apply to traditional IRAs, 401k, 403b, 457. So traditional IRAs and employer-sponsored plans. Again, we said you're going to have to take it as soon as you turn 70 and a half. Now, essentially the rule states that you have to take it by April 1st the year following the year you turn 70 and a half. So in fact, you can delay what's called your required beginning date, and that is for your first distribution. You can delay that. This is one of those complexities that you're going to want to discuss with your tax preparer or with your plan administrator or both, or financial planner or all of them. And the reason for this is that when you take a required minimum distribution, the way you're taxed on that is going to be as earned income or regular income the year that you take that distribution, which means that those distributions, those RMDs, are going to increase your gross income as reported to the IRS. And so the first consequence of delaying your RMD, so I should say, what would a delay mean? Well, the RMD is required to be withdrawn by December the 31st of whatever year it's owed. But for your first one, you've got a one-time delay that you can utilize, which pushes it to April 1st the following year. So the first consequence of doing that is that that following year you're actually going to have to take 2 required minimum distributions. By April 1st, you'll have to take the one that you delayed, and then by December 31st, you'll have to take the one that is owed that year, and you can't delay that one. Now, the second consequence of doing the delay is that the way in which the required minimum distribution is calculated is it's a division problem based on the amount of money in the account that is susceptible to the RMD divided by a divisor that sometimes is called the RMD divisor or the life expectancy number. And the IRS has multiple tables on this depending on your situation, but you take the divisor from the applicable table and you divide the amount in your account by that divisor. Now, if you don't take out your required minimum distribution, the first one, by December the 31st, then your second RMD calculation is going to be slightly higher than it would have been because there's going to be a little more money in the account, presumably, than there would have been had you taken your RMD out. Now, we're abstracting away from market experience and investment experience here, so I am not, there can be all kinds of complexities, again, that arise based upon how well the account is doing. Maybe it's loss value, maybe it's gain value. So consult with your plan administrator, tax advisor, or somebody competent in that area. Now, there is also the possibility of delaying the required minimum distribution until retirement for those people who work beyond the age of 70 and a half. Now, the thing you have to realize about this is that this draws a distinction between a traditional IRA on the one hand and employer-sponsored plans on the other. So if you have a traditional IRA, you have to take the required minimum distribution out regardless of whether or not you're technically retired or not. If you have an employer-sponsored plan, then you can postpone taking required minimum distributions until your actual retirement date, provided you're still working, as long as certain requirements are met. And those include, number one, you have an employer-sponsored plan like a 401k. Number two, you have to have that 401k with the employer you're actually working for. So it can't be a previous employer's 401k. You can't postpone that. And the third requirement is that you have to own less than 5% ownership in the company that you're working for. So if it's your own company, the IRS is basically like, well, you could basically say, I'm just going to continue working for the rest of my life because you have these ownership interests, and just continue to delay it indefinitely. So basically the fundamental principle of the RMD is that the IRS has stated you cannot keep funds in your retirement account indefinitely. That's the motivating factor in forcing you to take it. So we talk a little bit briefly about the calculation. So the calculation is, again, based upon the total amount that is susceptible to the RMD, and then there's a divisor that you use to complete that division problem. Now, there are several tables. There are actually 3 tables, I believe, that the IRS uses for these divisors. One of those tables is for persons who are married where there's an age discrepancy of greater than 10 years with the person and the spouse. The second table is where that age discrepancy doesn't exist. Now, there are other caveats, so again, consult the tax preparer. The third table is for people who are the beneficiaries of qualified accounts. So if you own the account, it's going to be one of the two tables based upon your marital status and the age of your spouse. And if you have become the beneficiary of an account, or if you've actually inherited this through the death of the primary account holder, then this third table would be applicable to you. Now, one question is, can you take out more than the required minimum distribution? And you can. When you think about what that word, or that phrase again means, required minimum distribution, it's the amount the IRS is going to force you to take out at minimum, but you can take out more than the required minimum amount. So for some people who are living on their IRA or 401k distributions already, the RMD may not be a factor. Again, consult with your advisors who are familiar with your situation. If you take out more than is required of you 1 year, does that reduce or eliminate the required minimum distributions in future years? And the answer to that is no. Every year there is a required minimum distribution based upon your total balance that is susceptible and your age and the applicable divisor. And if you're taking more than that out, then you don't have to worry about taking any extra. But if you take more than that out 1 year, you have to recalculate it for subsequent years. The extra doesn't carry over. Again, we said the deadline is December the 31st. We talk about the third table, where if you are the beneficiary of a plan, you've inherited a plan, then the rules are going to be different. For you, you are going to have usually two options, and the first option as of right now, and there is legislation presently that might alter this, but as of right now, if you are the beneficiary of a plan, of an amount in a qualified plan, then you either have to completely distribute the amount in that vehicle in 5 years, so over 5 years you have to have taken all the account value out, or you have to distribute it over your life expectancy. And so for that particular option, there's an RMD divisor table that is specific to people who are the beneficiaries of qualified plans. Let's talk about rollovers. Do rollovers make any difference? So a rollover would be where you would take, let's say, your 401k and put it into a traditional IRA. Now, there's no tax consequence for doing that because the rules around the 401k and the IRA in terms of taxation are essentially the same. But because they're the same, and because you're not touching the money, you're just changing the custody, basically, of those funds. Because they are still under the same tax qualifications, both of them have required minimum distributions. They're susceptible to them. So moving money from a 401k to an IRA does nothing to eliminate, reduce, or delay required minimum distributions. Now, there is a special case in which moving money from an IRA to a 401k might help to delay required minimum distributions. And that would be, again, we said that if you're still working after the age of 70 and a half, you have to take distributions on an IRA, but you can delay distributions on your employer-sponsored plan provided you're still working for that company and you own less than 5%. So some advisors might tell you, if you're still working, hey, you know what, if you move your IRA into your 401k, then you won't have to worry about the RMD on it. Now, a couple of things, at least not that year until you retire. A couple of things. Number one is that whether or not this is a good idea is going to depend on your specific situation and a lot of other factors. So I would tell you consult with somebody who is competent to advise you. But there are a number of things to consider. The first one is that you're still getting older, and so as you age, the amount you're required to take out increases. So you're not essentially reducing, in principle, you're not reducing the amount of money you're going to be expected to take out of these accounts. That's the first thing. The second thing is some 401ks are going to have fees and the like of that, so you want to carefully evaluate whether moving money from an IRA into a 401k is a good idea from the standpoint of fees. The other thing would be investment experience. Obviously, if the 401k is doing poorly compared to the IRA, you probably wouldn't want to move money into it, more money into it. And the other thing is going to be the tax rates. So we think about having to pay tax as a bad thing, something you want to avoid, but since it is unavoidable, you cannot get money out of a 401k or an IRA without paying some tax on it. Really, your question is, do you want to pay it now or later? So one important thing to bear in mind is, if you think taxes are lower now than they are going to be, and I don't have a crystal ball, I don't know about you, but if your intuition is that taxes are going to be higher, then delaying the RMD is really not going to benefit you, since if your delay is going to cause you to be in a higher, whether it's a higher tax bracket or just a higher percent that you're paying on whatever bracket you happen to be in, if tax rates go up, then you're not doing yourself a favor by delaying it. So again, have this conversation with advisors, think it through, and try and make a decision that you think is best for you and your family and your situation. The penalty, we'll talk just a minute about the penalty. So there's a hefty penalty if you don't take the correct amount out in a given year, and that penalty basically is 50% of the amount that has been failed to be withdrawn correctly. And so, for example, let's say you have a 10%, or let's say you have a $10,000 required minimum distribution in a given year, and you don't take any of it out, you miss it completely. Then the IRS can charge 50%, meaning $5,000 as a penalty for not taking that money out. And you have to realize that that is in addition to whatever regular income tax you would have paid on that money. We have to separate. I know it's hard, I've said it in other places, but we have to think there's a penalty and then there's the regular income tax. So in many cases we think of regular income tax as a penalty, but you cannot escape paying tax. So you can escape paying the penalty, however, if you make sure that you take your RMDs correctly. Now, if you take a partial RMD, so let's say, for example, you owe $10,000 and you take 5, and maybe your math is off or you forgot about an account or whatever, then the IRS still can take 50% of the amount you should have taken but didn't. So if you owed 10, you took 5, the amount you should have taken but didn't is an additional 5. They can take 50% of that, which would be $2,500 in this example. So it's a hefty penalty. You want to make sure you don't run into having to pay it. And by the way, in IRS publications, and one of the relevant ones would be 590B, in those publications, the IRS puts the onus on the account owner. They basically say, look, you can trust your 401k administrator to make this calculation, but at the end of the day, it is your responsibility to make sure the correct amount has been withdrawn. So just bear that in mind. There is a possibility that you can be granted a waiver and that the penalty can be waived. There's a form 5329, I believe, that enables you to basically request this waiver. And the reason would be if there was some kind of reasonable error or oversight and you can demonstrate that you've taken steps to rectify it, it is possible to have that 50% penalty waived. But again, it's better to be proactive and not put yourself in the position of having to file something like that. Just another point. If you have multiple IRAs, multiple 403Bs, multiple 401Ks, you have to realize something additional, and that is that the IRS wants you to calculate the RMD on each one separate. However, for IRAs and 403Bs, you can actually take the total required amount out of any individual account. You could take it out of one, you could take it out of more than one, you could take each individual required minimum distribution from each account. You got your choice. For 401Ks, on the other hand, 457s and other employer-sponsored plans of those kinds, the required minimum distribution has to be calculated on each one, and it has to be taken separately for each account. So in conclusion, I hope that something that I said was of value. I hope if you did find something to be useful in this video that you would please like it, subscribe to the channel. Both of those things help with the ratings according to the way YouTube computes these things. And feel free, to leave comments if there's something you think that I have forgotten to discuss. This is very complex, and in thinking through it, I'm hoping, to get a better handle on it myself, and to help other people to sort of get a handle on some of these topics, because they're important. As I've said in other places, my mom is having to delay retirement because she can't meaningfully enter into it, and she's going to be faced with a lot of these issues, so I'm having to sort of advise her, and her situation was made extraordinarily poor by a Medicaid spend down that we had to go through. So I feel like having this financial knowledge would have benefited my dad, would have benefited my mom. They didn't have it, and I don't want to run into that same situation. Just in summary, we were talking about required minimum distributions, and for the most part you can think of it as if you haven't paid tax yet on the account, they're going to start making you pay tax after the age of 70 and a half. It's taxed as normal earned income. So your normal income tax bracket and rates would apply, whatever that is for that given year. I appreciate your time today and hope that you will check back for additional content. I plan on having additional videos. There are other pieces on 401k in specific, on IRAs, on Roth IRAs, and the like of that. And again, I thank you for your time. Thanks.